Before I start, I just want to get a few hands up. So apart from the farmers, who here has a close friend or a relative who is a farmer? Just put your hands up. There's quite a few. All right, just leave your hands up if you yourself thought about farming one day. Yeah, this is fair viewers. I'm just going to pick on Amy. You had your presentation yesterday, so I'm going to pick on you. Why don't you go to the bank and get a $5 million loan to go farming at the moment? Exactly. And we really, in Australian farming, we assume the fact that to be a farmer, you have to own a farm. And to own a farm, you can't go to the bank and get a $5 million loan. You're going to need at least half of that in cash. And unfortunately, I'm a uni student. Centrelink's great, but it's not that great. So I just want to leave you with that and just have a thought. Maybe if we're really only leaving ourselves with the sons and daughters of existing farmers to take over these farmers, how do we actually ensuring we have the top people managing these farms in the future if we're just pulling from such a small pool? So I just want to keep that in mind as I go through. Anyway, so my name's Dylan. I'm here as a farmer, a Nuffield scholar, and as a passionate proponent for our regional economies. Firstly, before I go through, I'll just thank GRDC and Nuffield for sponsoring with my Nuffield scholarship, which enabled me to learn about the various financial risk management options used in ag around the world. I use it to understand the relationship between risk and profitability and the access to capital in ag economies. So going back, just introduction about our business in the low rainfall zone. We are a typical family farming operation in the low rainfall zone of WA's northern wheat belt. And according to Plan Farm's published 10-year return on capital figures, it's actually a great place to farm. It's that red star in the northeast, and despite being in the red zone on Neil's chart, and everyone we say we're in the red zone of if you looked at the return on capital, apparently it's the place to farm. And then if you asked everyone farming there, they all dream about farming in the 3% area. So it's a bit of an interesting paradigm there. But there's a bit of a reason there, and it's a bit of a false, misleading figure, that return on capital. Drought is a severe risk to our operations in our area, and so while the average 10-year return on capital is around 10%, that ranges between -25 and +35 year on year. So it's pretty severe. And traditionally, we've managed this by ensuring that our business has got enough cash on hand and unleveraged assets that we can cope with successive poor seasons. And I guess in this modern age of increasing competitiveness, and we're getting an introduction of external agriculture and corporate interests coming into agriculture, I just question whether having unleveraged assets isn't going to be impeding us from being able to really compete with these slimmer margins in the future. So, with the aid of the Nuffield Scholarship, I went on a bit of a small journey through 14 countries over about 18 months to find out. And I sought out the farmers, their lenders, and insurance brokers, reinsurers, academics, investors, and economists, looking for examples of different risk management tools and the way they affected how the farm businesses operated, and also how their communities and economies use them as well. So, apart from really finding out that it took me to actually leave the country to get it to rain back at home on the farm, I found out a few other things along the way. So, nowhere else is like Australian grains industry in terms of our weather exposure and production volatility. And then certainly not in the developed world. And the more developed and competitive an ag economy becomes, the lower the profit margins and more significant the complaining about how land prices are too high, but also the more healthier the local communities and their economies become. Now, Subsidies are not the only, nor are they the most significant reason why crop insurance programs have been successful in other economies, but not in Australia to date. And what I found was that traditional crop insurance products are becoming old, clunky pieces of technology, and index insurance seems to be superseding it through cost efficiency, and particularly in developing countries. So depending if a glass half full or glass half empty, I sort of came to the conclusion that actually the Australian ag economy is closer to developing countries like Brazil and Ukraine than it is to developed ones. And that really excited me, because that means that we've got such a big, enormous potential for growth if we can really manage our risk and enable us to invest in our businesses. So I went to many places, and I was trying to find out somewhere which had a similar risk productivity climate to our own. It was really hard to find, and the closest I could come to was Montana in the US. In Montana, I really wanted to see how they were different and how they were similar, and to see how their use of risk management products had affected on a local community scale. So Chester, Montana, it was surprisingly similar, but economically it had some major differences. So Chester's a small town in Montana, and it had a few hundred people, and there was very similar to my hometown, home shire, Perenjori. The towns and their businesses rely solely on the surrounding farms. Droughts are their major risk, and their long-term wheat yields are between 1 and 3 tonnes a hectare, depending on how much rainfall they get. But they're increasing with better production systems, and most farming systems have gone from fallow wheat and pasture to legumes, wheat and wheat in their rotation. The farm costs and their profit margins were pretty similar, but the key difference is that their profit margins are much less volatile due to the US crop insurance program. Now, this sort of brings me to some key differences. So the crop insurance program is subsidised, and the subsidy works out to be about Australian $25 an acre each year. But because it's been around for a long time, that subsidy has been built into the land prices. So while the insurance product still benefits the farmers, the subsidy actually only benefits the landowners, which in this case isn't necessarily always the farmer. Now, back of envelope estimates, I would say this subsidy boosts land prices by about $600 an acre Australian, but even with this massive boost, we still see a massive difference between the land values from home to Montana. And I really want to know, well, if the lease values and the profit margins are the same, how is this so? And really what it came down to is that there's the competition and the process of actually buying land. So the land market is much more competitive. When a land parcel comes up for lease or buy, small and large farmers, young and old, compete for the same parcel of land, because it's not limited to by how much existing capital you have, rather than it is to what your profitability of your business and your operation is. Some farmers are borrowing 80, 95% of the value of the land, and that comes down to how liquid the market is. And because there's less economic shock from drought, there is businesses in these small towns like lawyers, hairdressers, surveyors and workshops, and they haven't had a reason to pack up and go to larger regional centres because they haven't had that drought shock in the last 30 years. So I really had to sort of think, is this just a case of, the grass is always greener on the other side, or was this a healthier local economy? Now, I asked farmers in the EU, the US and the Canada, would you still farm? Would you still choose to take out insurance if the insurance wasn't subsidised, which would effectively double their premiums? And virtually all said, yes, we still would. So, And when it comes down to it, there's actually some Canadian farmers who are actually doing just that. There is some there's some companies, private companies that have popped up in Canada offer private insurance which is completely unsubsidised, and it's competing with the local government subsidised products. Now, these products are multi-peril type products, but they are able to operate in that environment because they can cherry pick the top low-risk producers. There's no subsidy strings for them to offer insurance to everyone. And they can cherry pick because there is a government data. They can type in that farmer's primary producer number into the government database, and they have a history of their production and other performance targets that, unfortunately, you can't do the same thing in Australia. So while some of these companies are expanding to the US and they're looking at Australia, it's very difficult for them to do that in Australia when they have to rely on self-reporting of this type of data from the farmers themselves, and it's quite a big administrative burden. Another interesting product I came across was by another Nuffield scholar from the UK. He's now the founder and CEO of Stable Price Insurance. They're an index insurance company that insure over 3,000 different commodities and in about 40 different countries now. And one of the most fascinating products they had was in conjunction with an Irish dairy bank. The bank wanted to reduce their own exposure to low milk prices and still enable capital lending to their dairy farmers in their area, particularly the more progressive ones. So the bank partnered with Stable to offer mortgages and on land expansion for dairy farmers in conjunction with milk price insurance. And the grower obviously had to pay for this insurance, but what it came down to is the interest rate reduction from these loans actually completely offset the cost of the premium, which really surprised me. However, Richard, the founder of this product, was actually disappointed that he thought their modelling suggests it should have been even cheaper again. Now, I think this is just a fantastic example of how a product which combines profitability, risk and capital access to benefit not only the farmers but the investors and the ag lenders themselves. And I feel a similar approach is going to be necessary in Australia if we're going to get some traction. So I think if we want to use risk management products in Australia, these products need to be designed in conjunction with our capital providers. These might be banks or joint venture partners. They could be the landowners who we lease our land from. But if we can de-risk our capital, then we can separate the actual farming operation from our land assets. And I think that will provide some really exciting opportunities for Australian ag. So coming back home, so what are we doing with our business now? And so since, I guess, the reinsurers have pulled out of the multi-peril crop insurance market for various reasons, for the last 3 years we've actually purchased weather derivatives to hedge our risk of drought. And that's, I guess, a little bit fortunate in our area in the Northern Wheatbelt WA, is that our risk is pretty much solely on lack of rainfall. And there's a pretty good linear relationship between our production and rainfall we receive. So that makes it reasonably easy to get into these types of products. Compared to multi-peril, we ensure our predicted water use efficiency and our farming performance into the future rather than our historical performance. And it's available immediately on most Bureau of Meteorology weather stations, and we're lucky because we have one adjacent to our farm. We received our first payout last year due to the dry finish of the year. So we use this product to give us greater certainty on where we're going to end up economically at the end of the year. So, and we know where our financial position is going to be. Now, this gives us greater confidence to expand and make assertive business decisions. Probably one of the most the biggest things it benefits is our ability to forward sell grain, given that we have a lot bigger certainty and ability to hedge our production. I feel with what we're doing that the net cost of this product, which I think is around $8 to $10 a hectare for us, I think the decisions we're able to make by leveraging ourselves more and having that extra confidence more than makes up for that sunk cost in this insurance product. And that's for our operation with what we're doing. But there are some barriers to adoption. There's a reason why farmers aren't all jumping into this product. Now, because the current available products are options, or like insurance, they have an upfront cost. So that costs us to about $200,000 each year. And at the start of our growing season, in a case where we're trying to already leverage ourselves and try and borrow the most we can to expand and get some economies of scale. So this means an extra $200,000 of peak debt in a growing season when our access to capital is already limited. So this off-puts a lot of growers. So some will either choose not to take it out, or they might take it out but not really at a small level, which doesn't cover their drought risk completely. There are ways around it, but it requires the involvement by our ag lenders and insurers, and we need to sit down in the same room so we can really get a better understanding of how it works. Another big barrier to adoption is in WA, I have to purchase this product as a derivative because there's a 10% stamp duty on insurance products. Now this makes it too expensive to take up under insurance legislation, which has a really good consumer, is definitely preferable on a consumer level. Now, derivatives are also regulated, and they can only be offered to wholesale customers, but ones which already have a fundamental understanding of how these products work. Now, that's great for someone like myself with a background in trading and finance, but that doesn't apply to a lot of small and business farmers. Now, currently, ag lenders are happy to support the uptake of these products. However, their risk assessment program does not objectively assess these products as part of the risk assessment for making loans. So until they are better understood by farmers, third-party advisors and our lenders, they'll continue to be judged subjectively. However, there are alternative capital providers who are seriously looking at these sort of projects on how they can use them to invest into agriculture. And I guess there's a potential they might sort of force the hand if they're using these products to offer alternative capital to farmers, then we might find that they could be able to force the hand and encourage a faster uptake by a broader industry. And finally, there's some farmers who just don't have near enough weather stations to use these products at the moment, or they've got to suffer from a mixture of drought, frost, heat risk, which means they can't really accurately predict how the weather data translates to production on their farm. But there are other ways we could do it, not just weather data, for example. And reinsurers have actually got these ideas already working, and they're already working in other countries. For example, I think there's a product in India where they look at Shire average. The index they insure on is the Shire average wheat yield, which is at a very small level, and they don't need the weather data for that. But it's only available because there's a government agency which reports data down to that granular level. There's remote sensing products available for growers who might want to, particularly it's been used in the US with pasture insurance, where growers can insure the biomass growth score from remote sensing satellites over a given year, rather than necessarily the direct weather data. So with remote sensing and yield prediction algorithms, we could alleviate this issue of lack of data without too much extra investment in data capture. That we don't necessarily have to have weather stations on every farm. However, I certainly think it would be helpful. So what do we need to do to access and utilise these products? So no matter what type of product it is, the lack of agricultural performance data makes it unnecessarily difficult for our agri-finance sector let alone for new insurance products we're trying to launch in Australia. Now, I think that can be fixed reasonably easy. Our agri-finance companies, the crop product retailers and other capital providers also are looking for growth, and they need reduced drought exposure. So newer finance products, I think, will have to be more flexible, they'll have to be more innovative, and they have to be more able to identify and target better performing farmers, not necessarily those just with an existing, better, more available capital already. We as farmers and industry really need to adapt to lower operating margins and higher land values. The family farm model, adverse to leverage, is not going to compete with larger corporate models, and especially ones with better geographical spreads and deeper pockets. We should be working with, farmers should be working with our ag lenders and insurers to develop products that are going to suit our needs to enable us to survive and thrive into the future. Thank you. I'll leave everyone, but just reminding that I'm really excited about the future of agriculture. I am in the red zone. We do understand that there are going to be some climate challenges, but I just feel like there is the challenge of volatility. I feel like is certainly one we can overcome, and I think there's so much new technology available, and if we can get that capital to access that, I think it will help us, not only survive climate change, but enable us to thrive into the future. So thanks, everyone.